And 72% of the time the market goes up. And the answer came to me. And that's what I developed my chart. The answer came to me is because, just like Caterpillar, when they pull their money out, you get out. Whoa.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. Are you nuts?
With your host, Phil Grande.
Bye. Welcome to my podcast. Thank you for joining me this afternoon. A lot to talk about. I had a laugh today. North Korea, one of the regulators for tech stocks up there, said that he thought the AI market was getting a little heated. He's getting a little overheated. What's he, nuts? He's a little late to the party. Overheated? He's a little late. Everybody knows it's been overheated for a long time. My God, when we bought stocks back in March and April, we still own them. We knew they were overheated even then. But let's talk about what happened today, why the Nasdaq collapsed today. It wasn't because of the North Korean regulators saying they think the stocks are overheated. It's because of the 2-year Treasury yield, the most important Treasury yield in the United States. Most people ignore it. Everybody looks at the 10-year yield because that's mortgages. And everybody looks at the Fed rate because that's what they cost. That's what the banks charge, or the Federal Reserve charges your bank to lend it money so it can lend to you, which reflects in all the things you buy, your credit cards, auto loans, that sort of thing. But the 2-year Treasury is the most important because it affects everything. I mean, yes, the Fed rate will affect the bank's rate, what they're paying the Fed to borrow money. And then they turn around and they charge you more because the Fed's charging them more. And all those things that you get hit when there's a Fed rate hike affects you, credit cards, so forth. But it also gets hit again, it gets a double whammy when the 2-year Treasury yield goes up. Because again, that's the most important, because that's the one that is keeps going up because of the deficit. So I'm going to explain how this all comes together today. So this morning, when the market, when the tech stocks, Nasdaq sold off almost 1,000 points, around 913 points, nobody really understood what was going on. Well, it's simple. The yields, that 2-year yield, which is around I think, what's it right now, 2.11? Something like that, around 2. What is it at? 4.19. Normally, it's around 3.25. 4.19 is huge. And so that's the yield that causes all the havoc. If you're a business person and you have lines of credit for your inventory and you have a line of credit to meet your payroll, and I mean, that's the one that whacks everybody. The reason it whacks everybody is because it goes up as it's tied to, again, what's going on with our deficits. So the more that our government, every day we go in a hole, we spend $5 billion more every day that we take in. Well, they have to raise that $5 billion during the day. And they do that by short-term bonds. And they go right, and they sell the 2-year Treasury. The Treasury, like selling the 2-year Treasury, is the T-bills. And so what happens is that 2-year Treasury becomes very important. So every time our deficits climb, every day we're in the whole $5 trillion. We got to sell bonds during the day to cover our overhead. That yield keeps going up. That affects your credit card, everything else. At the same time, when the Fed rate goes up, it affects the same thing. But we haven't had a Fed rate hike in a long time, right? So again, to understand the market in how it works is that 2-year Treasury yield is important, but you've got to also remember there's $50 trillion. Think of a big lake. There's $50 trillion. Okay, that's what drives our stock market. That 50 trillion. Those are the institutions. That's the pension funds, that's the mutual funds, that's the hedge funds, insurers, wealth funds, everything. That's how much money the institutions have from them to manage. So again, that 50 trillion, we're not even using 70% of it. The institutions have taken money out of the market. So in other words, think about this. That's what drives the stock market, not Wall Street, not with their storytelling using fundamentals. Forget all that. That doesn't drive the market. They have no power. They don't drive the market. They used to until 2008 when the market dropped 54%. We lost $8 trillion. And finally Congress and the Fed, everybody got together. And what they figured out was the reason why the market, one of the biggest reasons why the market crashed is because of these newsletters. It was a $50 billion newsletter industry. And these newsletters are full of crap. What are you nuts? I mean, these newsletters are lies. And so at the end of the day, when we went down 54%, lost $8 trillion, they started to look into these newsletters, and the newsletters were all BS. People were doing exactly should have been doing the opposite of what these newsletters were saying. So the newsletter industry collapsed, went down to $5 billion from over $50 billion. At that point, the big boys in Washington met with Wall Street and said, no more. No more are you going to continue to tell stories to get people to buy your stocks. Because remember, they buy the stocks first, then sell them to you. It used to be where when you paid a commission, it was a pure commission. They didn't buy the stocks first. But when discount brokers came in, and before discount brokers, people were making $100 to $300 in today's money on commissions. But they worked hard for you. They worked hard for you. It was worth it. But then when the discount brokers came in $5 to $15, they couldn't make any money. So they said, well, then let's do this. Why don't we go in and let's buy the stocks first, and then we'll mark them up to the retail customer. They won't know the difference. And that way we're going to make a ton of money. Well, that didn't work. That was stupid, because that's like going to Brooks Brothers and buying a suit for $500 on the rack, thinking go outside the store, put it on the rack out there for $1,000. That didn't work. So the next thing they did, they said, okay, that's not working. Then why don't we turn around and let's manage money for the big pension funds. There's like 12 major pension funds. You have the steel workers, auto workers, teachers union. Let's manage money for them. But there was a problem with that people were shorting stocks. And take like Enron. When Enron had his big heyday and kept going up and up and up and up, when it started to collapse, what did they keep telling the retail trader? Cost average down. Keep cost averaging down. Buy on the dips. And they told them to buy on the dips when there was no QE. You never buy on the dips when there's no QE. And so why did they do that? Well, they put fear in the retail investor never to short stocks. If they short stocks, you're going to lose your house. You're going to lose everything. You're going to lose your firstborn. You're going to go blind. I mean, it was unbelievable what they're saying about if you shorted what would happen to you. Why? Because remember, these brokerage houses on Wall Street were making a ton of money in commissions from the pensions. So when stocks were going down, they had to get them out before they collapsed. So before Enron totally collapsed, they had to get them out. So how did they do that? Well, they took parking space in the heads, of the retail investor, thinking he sits on the world's longest stupid bench, telling them, never short, never short. So they didn't. So as Enron was collapsing, they kept going in and buying on the dip, cost average down, holding up Enron long enough to get to get the big institutions out. of those stocks. And that's where everybody has gotten so fearful of shorting. And that's what Wall Street has done. Now, what's that have to do with what happened today? So, people don't short. They're too scared. So, these stocks, if you take the four biggest stocks, there's about 12 stocks that are holding up 700 stocks. They're all tech stocks. Four are the four big companies that make the machine that produces chips. And then you have companies who buys those machines. You add that up, that's about 12. That's the whole thing holding up the market. That's it. It's holding up the whole stock market. Now, let's drive back in the institution money. So what drives the stock market is institutional money. That 50 trillion. But what did the institutions do? They took their money out. There's only in the market, $2 to $3 trillion. That's it, 2 to 3 trillion. So 70% of the 50 trillion that should be in the stock market is gone. And when you don't have the institutions, what happens? What happened today? Computers, bots are programmed to kick in. So when a stock market, like today when the Nasdaq went down 900 points, the computers are selling the Nasdaq stocks, not the institution. They're not participating. They only have 2 to 3 trillion in the market, and it's just rotating. So the computers kicked in, started to sell all their contracts. Stock market started to go down, and then once they're done with their contracts, because it's computer selling, the computers are programmed to turn right around and start buying them back. This is what people don't understand. Institutions, when they sold, and say the Nasdaq went down 900 points, it would have stayed down 900 points. But it clawed back 500 because computers are programmed to kick right back in. Once they sell their last contract, kicks right back in, and it starts buying again. So if you don't know what you're doing, you can get into a trap. And a lot of people got trapped today who were shorting. Now, if you remember, a couple of weeks ago, we had 1,000 point, another 1,000 points. Remember days? Same thing. It was all computerized. The minute same thing. If you're buying stocks, and it goes up 1,000 points, okay? Same thing. All of a sudden, hey, we're up 1,000 points. And all of a sudden, boom, it drops 1,000 points. Or like the last couple of weeks, we had 2,000 point drops, right? They came right back, didn't they? The institutional money has to get back into the market, because if we keep getting this 2-year treasury because of deficits, if that keeps climbing and climbing, that's the killer. That's the killer. And that because it's killing the cost of money for AI. So what happened today, when whoever this guy was in Korea says, it may be overpriced, right? Are you kidding? We've known that for 2 years. We've been overpriced. We also know that the leadership stocks, about 12 of them, are going up when they should be going up. They're going up for the wrong reason. They should be going up when yields are low, but they're going up when yields are high. So today, finally, the computers kicked in, and they sold all these contracts, drove the Nasdaq down. Then the Nasdaq turned around, went right back up, and it clawed back about half of what they lost. Now, tomorrow they could claw back the rest of it. Until we get the computers out of here, the only way you get the computers out of here is you've got to get the institutional money back. But the problem with getting the institutional money back, that's a big problem, because we have an inverted yield curve. We have an inverted yield curve. Now, that's bad news. They're not going to come back when there's an inverted yield curve. In other words, we're at a plus 150. That's the place you want to be on a yield curve, 150. We're at minus 50. And I think we got about 120 points. About 120, I'm trying to find it here for you. I think it was about 120 points. We are 120 basis points short of institutional money coming back in. I'm just going to take a little more time here than I normally do, because I don't want to leave you here, because I want you got to understand what's going on and what's going to tell you when the stock market's ready to crash. Everybody asks, when's the market going to crash? When's the market going to crash? Well, you want to know when the market's going to crash? Simple. When the 2-year Treasury yield is higher than the 10-year, put your helmet on. But let's get back to what's the most important thing. Institutional money is out of this market. It's making it terribly volatile. And these AI tech stocks with that 2-year Treasury yield, instead of at 3.5%, and it's up over 4%, it's crushing the cost of money for AI. And that's why one of the big reasons why the market collapsed today. Now, the biggest stocks, like I said, if you have the 4 biggest chip machine makers, we've been in those, God, since March and April. Some of our people were up almost like AMAT, 41%. I mean, all of those stocks, those 4, everybody's up about anywhere from 55 to 80%. But they kept going up for the wrong reasons. You want them going up when there is low yields. That's what they like, low yields. But when they're going up on high yields, and yields are going to get higher and higher as long as the 2-year Treasury yield keeps climbing. And the 2-year Treasury yield is going to keep climbing as long as our deficits every day climb, where we spend $5 billion a day more than we take in. This is what people don't understand. And you've got to watch that 2-year Treasury yield, because if it overtakes the 10-year Treasury yield, you're going to have a correction or a big crash. Now, the money is the problem, because we only have $2 to $3 trillion of the total 50 trillion in the stock market. That's the problem. I'm going to get you the real number here. Here it is. So 70% of the money that used to be in the stock market by the institutions who drive the market, who's the power behind the stock market, they move the market. Not these dopes you see on TV, these jibber jabbers, buy this stock because of this, buy that stock. They always use a story using fundamentals, which is stupid, because fundamentals don't move stocks. They don't. Money moves stocks. Trend of money. If your trend keeps going up, that means money's going into your stock. It'll keep going up. It's the money that drives your stock, not some story. But Wall Street and these jibber jabbers keep doing the same thing, telling stories. But pros look at the money that's coming in from the institutions. When you got 50 trillion, and normally they don't put all 50 trillion in the market. Normally what's in the market is a minimum of 10 trillion. Minimum of 10 trillion they always have in the market. But no, they only got 2 to 3 trillion in the market. And then when you got the yield at 4.2%, we'll say, 4.2%, that's a killer. That's a killer. And do you know how much money AI stocks borrow? Especially for these centers they're building out. So again, the problem is that we can't sell bonds to banks anymore. They don't want them. Foreigners, our biggest purchaser of bonds, we love to sell them our bonds so we can get the yields down. The 2-year is at, as I said, is over 4%. Would it be nice if we could sell them a 10-year? But they don't want our bonds. They want nothing to do with our bonds. So first thing, the dollar is too high. And if that dollar starts collapsing, they'll lose money. So here's the bottom line. The stock market only works if there's institutional money in, because it's a smoothing mechanism. When institutional money is not performing, I think about it, they got 2 to 3 trillion, that's it. 2 to 3 trillion, I couldn't believe it, I just had to go check the numbers. Here it is right here. Out of the 50 trillion, think about how it works. Think of a big lake. There's 50 trillion in a lake. Then there's pipes out of the lake. Where do those pipes go to? The pipes go, if you want to buy tech stocks, another pipe goes to healthcare stocks, another pipe goes to home builder stocks. So you got this big pool of money with pipes going to the stocks. So when that money flows out of that pipe to go buy tech stocks, or it flows out of that pipe to buy healthcare stocks, if yields are low, it goes through very, very fast and quick, and then the market keeps going up. But when yields start going up, it blocks the pipeline. The yields, the money slows down, and that's when you start going towards a big correction or crash. Think of it as clogging up the pipelines. So here you have, okay, normally you got 50 trillion, but let's be honest, out of that 50 trillion, at one time, mostly they have, let's say, 10 trillion, 15 trillion that's working, okay, that's always working, buying stocks. Now they only have 2 trillion mostly that's buying stocks, which they don't buy stocks. That 2 to 3 trillion they have in the market, they don't buy stocks with them. They're just rotating, that's all. They don't buy stocks with them. So the point is that those yields, if those yields keep climbing, then the pipelines that go into buy tech stocks or healthcare stocks, whatever stocks you buy, get clogged up and it starts slowing down. That's when you run into this trouble. And that's what we have now. Now, it'd be nice if we could just get the foreigners and the banks to buy other treasuries, a 10-year treasury or but not these damn 2 years. And because, and believe me, the Treasury doesn't want to sell T-bills to them. Okay, that'd be too short a period of time. And that'd run them into real trouble. So the stock market will correct or crash once the 2-year Treasury is higher than the 10-year. Always remember that. You always know when the market's going to crash. You also know when the market's going to crash when you take and you watch two things. When the Treasury yield, okay, when that Treasury yield, again, crosses, okay, the 2 and the 10, that Treasury yield always tells you the close. If you take the 10-year Treasury, use the 10-year Treasury. If that gets closer and closer, the 10-year Treasury to around 4.5, 4.5 is a killer. That puts you into a real bad place in the stock market. When you're near that 4.5, you get over that 4.5 to 4.75, it's telling you your tech stocks are going to blow up. We watched that one too. But the more important one is to watch the 2-year, because that's the whole ball game. So if you watch the 2-year, if that keeps climbing, then you know institutions aren't into the market. If institutions aren't into the market, they don't have that much money in the market, and we're depending on bots or computer trading, then every time you get a big move, if the market rallies 1,000 points, you know it's going to turn around and come back down. It'll trap you. If it goes down 1,000 points, it'll go back up again. Sometimes half, or sometimes it claws it all back. So either direction, this is where the volatility starts hurting you. Because either direction, you buy the market stock, you go long, you buy GE, you think the market's going up, all of a sudden you look at the market, it's going up 1,000 points, and then you add another 200, 500 shares, then all of a sudden the market was up 1,000, it drops down to 500. You just got clobbered, you got caught in a trap. You get caught when you're shorting in a trap, same thing. So like today, the market went down nearly 1,000 points, and then the computers kicked in and started to use their buy contracts. They don't support their own positions. Institutions support their own institutions. If a stock market drops 1,000 points and it's the institutions that are in charge, it caused it to happen, they'll hold that short down there. So or if the market goes up 1,000 points, you don't have to worry about it coming back 800, 900, or even 1,000 points, because they'll hold that position. So institutions hold the up position and they hold the down position. Computers don't do that. They do the opposite. If the market goes up 500 points tomorrow and you're sitting there and you make sure, oh boy, I'm making back, I'll put another 200 shares. Oh, this is great. Then all of a sudden in the afternoon, the market, instead of being up 500 points, now it's only up 100 points. What the hell happened? Because computers will reverse the buy to a sell, because that's how they're programmed. Okay, so I hope that helps you understand that the market right now, the crash will come once the 2-year crosses the 10-year. Until then, it's not going to happen. The volatility, if all of a sudden you get a big rally up, and all of a sudden you see it come back down, or you're short, it goes down perfect, and it starts coming back up, that's because the institutions, okay, the institution's not involved. It's the computers. So make sure when you get a big rally, you take profits, you sell into it. Or if you're shorting, it goes down, you take profits, you sell into it. You can't just stay there and say, oh God, it's going to go up again tomorrow. Computer trading is the worst thing ever happened, okay? So, and watch that 2-year treasury yield, because that's the one that kills tech stocks. The higher that 2-year treasury goes up, always think about the 2-year treasury, you want it to be around 3.25, or worst case 3.50. That's where you want it to be, okay? If it can stay there, then we're good. But when it gets up to where it is now, we're not good. That's it. So I'll play one more cut for you. Play the other cut, the other 2 cuts.
Our advice is to remain overweight the AI sectors.
Can you imagine these jibber jabbers on TV? What are they, nuts? See, that's what they do. That's their job. That's their job. That's how they make money. These TV shows. They make all their money from advertising, okay, from all these big brokerage houses. So they just totally lie to you. Always follow the trend of your stock, because that's the trend of money. The trend will never lie to you. Never lie to you. It always tells you the truth. And the yields will never lie to you. Okay? All right, that's it. I'll see you on the charts. If you're not a gang member, join. It's free for 10 days. Love to have you. See you on the charts.
Are you nuts?